No, thank you very much, Mark. It's really a pleasure to be here. And yeah, as I explained to Mark beforehand, the financial sector is seen as quite a technical one, with a lot of knowledge required. And last year, during the COVID pandemic, when it was at its height and the economies were tanking, we did 4 webinars for our clients, just trying to hold their hands and explain exactly what was happening and how the bank sector was faring. And in fact, it turned out to be quite profitable for them, because we said in April, this is an investment opportunity of the decade. The sector is going to come through it very well. And since then, I think the fund is up about 80%. So today we face a different scenario, and I'll try and take you through that. So let me first just share the screen and the presentation. And that's always technically the most difficult thing for me. Share screen. I think I'm succeeding.
Got it, Corky. You can see it.
Yep. Okay. So is that visible?
Yes, that looks great. Thank you.
Okay, there we go. Okay, so this is always the moment of truth. It works. I'm going to try and just sketch the background first. It's very important just to understand, if we look at the next 3 or 4, 5 years going forward, just to understand exactly what happened last year. If I had more time, I would also explain what happened in the previous 10 years, because it has a bearing. And if any of you have questions, don't hesitate afterwards to via Mark or Nigel, send me a mail or directly, and I'm happy to just give more detail. But we've only got 25 minutes today, so here we go. Okay, very important to bear in mind that in 2020, we saw a very sharp contraction in the economies. Firstly, there was just this natural response of people and businesses to pull back, and then the governments forced economies to lock down. So you had sharp increases in unemployment, and there was a huge fear of large bad debts. Nobody knew exactly how bad it's going to be, and specifically the bank sector and obviously things like tourism and oil sectors were sold down aggressively. This graph is a Morgan Stanley one that they used quite a lot during the year, and but from the beginning they actually were fairly accurate. And what is important here, the yellow line is the GDP, the US GDP, gross domestic product of America in 2008. And what they try to show here is that in 2008, the recession or the contraction in the economy developed over 3 months, then gradually started getting better, but only 14 or 13 quarters after the start was the US economy back to where it was the beginning of 2008. So you can see it took 14 quarters for the yellow line to be back at 100. This pandemic was different. It was very sharp. You can see it was the contraction was double as bad as we had in 2008. But what was different this time is that central banks and governments had learned. In 2008, there was an incredible amount of bickering and uncertainty and infighting about the responses. And so the Federal Reserve Bank of America and even the government were very slow in what they did. Whereas this time, everybody had learned and the response was very quick. The key was on the 23rd of March, when the Federal Reserve Bank said that they will provide sufficient liquidity to make sure that the US economy and the globe gets through this pandemic without big problems. And thereafter, the US and other governments started providing big aid. And you can see how sharply the economies started recovering. So And the expectation is that now, by the fourth quarter of this year, we'll be back to where we were in 2019. The vaccination process has started. The COVID death rates are decreasing rapidly. Europe is still a problem. But generally, especially in the US, employment rate is starting to pick up very quickly. If you, same picture, and I just quickly wanted to talk on the banking sector here. So what you saw in that sharp downturn, sharp loan growth contraction, a large reserve increases. So the banks with the new regulations that were put in place post 2008 have to now every quarter provide for the loans on their books based on the situation as it is at that stage. Now, by the way, that is pretty silly to, if I can criticize what the regulators have done, because it means that at the worst point in the cycle, you are forced to take the biggest reserves. So the banks at Q2 in 2020 took massive reserves when at that stage, the economies were still contracting. And that's going to be important in the coming results, Q2 results, which will be reported in July, because year on year, there is going to be a massive change. We're now going to see, instead of big reserves in the income statements being taken, and so the banks took big knocks in the profitability, Q2 in 2021 is going to see the reverse, and in fact, reserve releases, because those reserves they took were for potential bad debts. And true, there have been bad debts, but not nowhere as close as feared because of the sharp recovery. So most businesses took corrective action and have survived. And so what we're going to start seeing now, loan growth rebound. And I must say there, maybe the word rebound is a bit optimistic. Rebound might be too strong, but certainly we are seeing a loan pickup again, demand for credit coming through, and that's going to be 2021, 2022 to measure how big that is. We'll come back to that a bit later. But the important thing, as I said, reserve releases. And then also during the crisis, the banks were not allowed to buy back shares and had to reduce their dividend payments. The regulators correctly, in this case, felt that it was of paramount importance to the economies that the bank and the insurance sector remains healthy and overcapitalized, because we didn't know how bad the problem was going to get. So they were not allowed to pay management, in fact, bonuses. They were not allowed to buy back shares or pay shareholders dividends. And that is all reversing now from 1 July, where normal payment of dividend and share buybacks can be resumed and capital can be returned to shareholders. Okay, so the next slide's a bit on the macro situation going forward, because I think that's the key to understand the difference between 2021 and 2 and 2020. So firstly, we've seen the US consumer specifically build up huge reserves, savings in 2020. People firstly couldn't go out and spend, they couldn't travel, they couldn't go to restaurants. And they were afraid of losing their jobs. So they did the natural thing, is to, as far as possible, save. So the US savings balances are as high as they've been in a long time. And so there's a lot of pent up consumer spending. And top of that, Biden, for a lot of reasons, decided to push through a 1.9 trillion package, which will start coming through now. Now, that is going to ensure strong growth in consumer spending. So if you just think of an economy, you seldom have an economy running at full capacity. And when it runs below its capacity, the economists talk about the output gap. So at the moment, there's quite an output gap in the US. That means the difference between what they are producing and spending and what the economy can produce. This package, if 50% of it is spent, is going to push America to above its output gap. It will close the output gap, and it will ensure that the US economy will run above capacity. Now, that has major implications because firstly, it will be the strongest US growth period seen in many, many years. Morgan Stanley and others are forecasting growth in the US this year of 6.5%. That is big. By the way, in India, expectations, or the government, Modi government, is trying to achieve a 13% growth. So you can see generally in the world, governments are doing what they can to ensure as quick as possible a recovery to the economies that will reduce unemployment. By the way, that US economy running above capacity is obviously very good for emerging markets because the US will need to import what it can't produce itself, being running over capacity. And so that's very good for countries that are exporters, especially of consumer goods. And obviously also for their currencies as well, as their trade balances will improve. Biden at the moment, by the way, is working on his next package, a $3 trillion package to boost infrastructure. Now that will also actually stimulate, if that gets passed through, huge demand for steel, cement, etc. So again, it will be good for commodities. Commodity prices have run quite sharply already. But again, it will be good for those emerging markets that export commodities. We'll come back to some of those later. But important for the financial sector and for the world, this will result in inflationary pressures. And by the way, both Jerome Powell, the chairman of the US Federal Reserve Bank, and Janet Yellen, head of Treasury, are quite happy with this. They believe that this inflation will be what they call transitionary. So it will go to 3.5% for 2 years and then fall away again. That's going to be the big question that occupies the minds of investors for the next 2 to 3 years, whether this inflation, so maybe just to make sure you understand, we're going to get inflation. There's no doubt about that, and will mostly start peaking or start rising sharply as the consumer starts spending. But the question is going to be, is this going to have the normal knock-on effects? So inflation breeds inflation because expectations change, or is this just going to be a 1-2 years and then inflation falls again? The Fed wants to run the economy red hot. They want to do everything they can to ensure it recovers as quickly as possible, bring unemployment back. So they're going to keep interest rates low during this period of increasing inflation. And so this lag in the Fed response in terms of short-term interest rates is, I said, will push, but it is pushing the US 10-year bond yield higher. The US 10-year, I don't know if you guys watch it, it's well worth watching at the moment. It's fluctuating between 1.65% and 1.75. Yesterday, for the first time, it went through 1.75. A year ago, it was 80 basis points. So it's already increased from 80 basis points to 1.75. If inflation goes above 2%, the long bond yield will go above 2. That's for certain. So we're going to see higher long bond rates, which, funny enough, will put two pressures on the US in both directions. One, the higher the rates go, that could mean inflows back to the US. But at the moment, because short-term interest rates are being kept low, the real long bond rate in the US is expected to be negative. And that will weaken the dollar against currencies that keep positive real interest rates. I don't know if you've seen both Brazil, Russia, and a few of the other emerging markets have already started raising interest rates. So those emerging markets with strong balance sheets and that preemptively hike their interest rates will actually get the benefit of stronger currencies as well. So, okay, basically the scenario I wanted to sketch, because this is important for the financial sector, we're going to see strong growth and low interest rates, low short-term interest rates, while the long end of the curve should start increasing. So the financial sector is at the end of a 10-year NIM or net interest margin and regulatory pressure. After 2008, the authorities said we never want to be in the position again where the world is beholden to a weak financial sector. So they put in place a lot of regulations which did two things. One, it actually ensured that the banks and the insurers had to increase solvency and capital ratios. So the banks and the insurers are now about 2 times as safe as they were before 2008 in terms of capital. They had to be more diversified in the lending portfolio. So the lending portfolios going into the pandemic were as diversified and as safe as you could get. And that's why the bad debts have been so small, so minimal. But that 10-year regulatory cycle of curbing the banks also had a negative effect of it kept growth low. If your banks are not lending or not willing to lend, it's difficult for your economy to grow. So your global economy was actually very weak and interest rates kept going down. So we've had 10 years of low interest rates or lower interest rates and regulatory burdens. We think that will change now. And in fact, I would almost say, for banks, the few years coming ahead is bank heaven. That's a term UBS coined in 2002, post the previous emerging market crisis and the 2000 post dot-com bubble recession, when we had similar scenario as now. Economy started recovering, interest rates were actually fairly low. Banks were actually going to see strong loan growth at wider margins. So the environment that we're going to see going forward for the banks and insurers will be totally different from the 10 years we've seen. But the main thing we will see banks going into this environment where loan growth will start to be better, their interest margins will be wider, and their books will be clean, and they will have excess reserves. And at the same time, banks and insurers have been doing what they can through digitalization strategies to really get their cost efficiencies better. And so they're actually like coiled springs on these low cost to income ratios. Okay, so I think I've explained more or less. I think you get the drift. The important thing is, as you'll see now, the valuations are still very attractive, and we think we could be at the start of a multi-year bank earnings expansion and re-rating cycle. So, okay, here's the first picture. You can see this is the price to net asset value. It's the best, in our opinion, the best way of deciding whether banks are cheap or expensive. So you can see here, it's below the long-term average. Long-term average is 1.5 times price to NAV. 1.5 means that they're trading at a 50% premium to last reported tangible book value. You can see in the period where we had bank heaven conditions, 2002, 2003, 4, banks traded at 2 times book because inflation was higher and interest rates were higher. We think the situation that's being created now by the Federal Reserve Bank is we could go back there. I'm not sure on that, but the probabilities is high that we'll certainly go higher. At the moment, the bank sector is still trading at 1.3, so it's an average of the last 10 years. But this is where it's important. We do think the next few years will be different from the past 10. This is the World Financials Index relative to the MSCI World. So it's banks relative to the MSCI World All Company Index, still at a 43% discount. And that is because, obviously, as you know, the low interest rates pushed up the prices of growth companies, specifically the tech sector. So the tech sector is at an all-time high, still in valuations, coming down, whereas the bank sector is at all-time low. And so one of the other forces we think higher interest rates will bring about is it will push down the valuations of the growth companies and push up the valuations of your cyclical and defensive companies like the financial sector. The European banks are actually the cheapest. We won't go too much in the European insurance, even cheaper. But if there's time, we can come back to that. I just really wanted to show you that the sector is cheap and it's entering a period which will be very conducive for increased profitability. Just a slide, but I really wanted to show, we can show lots of these. The insurance sector, if I did one for the banks capital, you'll see the same, that in terms of capitalization and solvency ratios, they are as strong and as healthy as well, double the strength and the health of where they were. In terms of the fund's exposure, the global fund that we manage, 70% roughly of it is invested in banks, about 25% in insurance sector, but mostly property and casualty. So that's a separate presentation. If I get Barry to talk on that, he'll tell you for an hour as to why that insurance, that sector is so mispriced at the moment. And we will come back to that just now. And then a few debt collectors and other beneficiaries. In terms of geography, the fund is quite diversified, 31% direct investment in the US, 13% in the UK. UK, we're expecting a very strong recovery. Johnson, for all his faults, has done a lot in terms of the vaccination process. In core Europe, we don't really like core Europe. They've got a lot of problems, although, as you could see, it is very cheap. But mainly in core Europe, we hold ING, which we think is one of the best banks in terms of digitalization in the world. And then Scandinavia, we really like Scandinavia. It's one of the areas that have come through very well this whole crisis, Norway and Sweden, and then Central and Eastern Europe. And Asia is basically India, Indonesia, where those India and Indonesia, between the two of them, will be the strongest growth countries in the world in the next few years. So a few examples. Firstly, just the portfolio characteristics. I highlighted the ones that stand out. If you just firstly look at the market cap, generally we are what we call bottom-up stock picking. So we go and find, and we've been doing that for the past 30 years. Well, me personally for 30 years. My team has been with me between 5 and 10 years. This fund, I've been doing it for 20 years, where we try and find companies that are better than their competitors and are taking market share. So normally it means they're smaller, they've got more entrepreneurial management. And so you can see in market cap, about a third of the size of the average. Dividend yields is fairly low because the companies we invest in are growing market share and use their capital mainly to grow. But the PE, you can see the market is still very skeptical about smaller companies. So the PE is 8 versus the MSCI World Financials of 16. So it's half the World Financials versus the World All Share Index P of 28. So you can see the sector is cheap, but the companies in the fund are even cheaper. I'll give you some indication now. But all these companies, in fact, each one that we own, we've known, depending on the company, but we've known them for at 8 years at least. Most of them we've been visiting for the past 20 years. We know these companies, we know their managements. They've got very good track records of showing shareholder value, growing shareholder value, and you can see they are just too cheap. And you can see that in the next line in terms of EPS growth, it's the fund's average company is expected to grow earnings 20% versus the sector of 14. Okay, the rest you can see basically it's cheap. I don't want to spend too much time on it. A few quick individual examples. JP Morgan, one of the largest banks in the world. This was our top holding during the crisis, but it's actually re-rated sharply. And there's one error I noticed in the presentation. See, the black line is the price to NAV. and that still shows at 1. That has gone back now to 1.5. There's a later slide where that has correct number. So that has come back, is back in line with the average. The important thing here, the red bars, is the shareholder value of JP Morgan. You can see how every year, consistently from 2001 right through to forecast 2021, it has grown shareholder value. Through 2008, it grew shareholder value. Through 2020, it grew shareholder value. And it's an incredibly good bank, very well balanced. It's still in our top 5. We've been reducing it a bit because it's now not as cheap as it was, but it's a great bank for the future. ING, as I mentioned, one of the best banks, well, we think it's the best bank in Europe. The table below, I don't want to go into too much detail, but it just shows the cost of bad debts compared to the European peers is very low. They've got excess capital. The forward dividend yield of ING is 6%, and it's still trading at 0.7 to its tangible NAV. So it's 30% discount. Here's one that we started investing in January, Shinhan Financial Group. I've known this bank since 2003. We have been visiting them annually. This is a fascinating picture, and I'm sorry, it's a lot of detail, but I thought it's the best way of just explaining what has happened. You can see in 2005, 6, 7, this bank used to trade on the top line at a price to NAV of 1.82 times. The share price then went up from 40 to 51,000 Korean won. That bank, due to consistently lower interest rates, has derated. You can see how it went from 1.8, which was quite expensive, over the years to now it's trading at 0.4. Yeah, 0.4. Got to say that 3 or 4 times. It's incredible. At a bank of this nature, with this track record, is trading at a 60% discount to its tangible net asset value. Despite, and in the 4th line, it shows the shareholder value per share, the NAV per share. It has grown every year from 22 to 84, where the share price has effectively stood still. Now, you know, that is basically because in Korea, investors started loving Samsung and all the other tech companies, and they just sold the banks. But Korea is actually doing very well. Exports are growing 15% year on year. It's pulled up as well by the recovery in China. They are going to start hiking interest rates as well. And at this valuation, on a 9% return on capital, remember inflation in Korea is below 1%. You're getting an 8% real ROE. I mean, this is one of the cheapest banks in the world, and we almost every week we're buying a few more. And then LIC in India, just to give you a flavor, and we're almost at the end. I think I've actually mostly run out of time. LIC, housing finance in India. Again, at this stage, you'll recognize the pattern. The one on the left, the red bars are the shareholder value. You can see how that has grown since 2003, almost every year. The line there on the left is the return on capital, which during the pandemic fell to 14%. Average return on capital has been 18%. And the graph on the right shows the share price. You can see how that fell for a number of reasons, 2018, 19, and during the crisis, it fell to just over 200 rupees. This bank is not a brilliant bank. It's not an ING or JP Morgan, but it provides housing finance in India, one of the strongest growth countries in the world. Housing is going to be very important in India. They've got a 20-year track record. We've been visiting them every year from 2003, and it is still trading on the blue bar. You can see it's still trading at the price to book of 1. In fact, it's below 1. You'll see that now on what I think is almost our last slide. L&G, I was going to talk about L&G, but it's one of the best insurers listed in Britain, UK, London, but it's actually largely also a global business. There's no time to talk about that. But as I said to Mark, at any stage, if you want more information or another call, be very happy to go into any of these points that we raised. So just very quickly, and I think this is the second last slide, the recent buys and sells. You can see the top 5, LIC, as I said, JP Morgan, the other 3, Citigroup. You can see the third column trading at a price book of 1. Now, Citigroup has had a bad past 10 years. It's recovered from the 2008 crisis. You can see on the furthest column on the right, it grew shareholder value at a very low rate. That is past. The bank has been restructured. It's on the front foot, and it's actually very cheap. Arch Capital is one of Barry's. It's one of the best reinsurers in the world. It's still fairly small. That's why we like it. And Renaissance Ray, trading at 1.1 times book in what we call a rate hardening cycle. So the shares that we added to is Legal & General, Key Corp, a regional bank in the US, Renaissance Ray, it's with Arch Capital. You can see it's trading at 1.1 times book. And then in Russia, Sberbank. Sberbank is also a very, very good bank. I forgot to mention TCS, Tinkoff. Go and look that one up. You'll see how incredibly well that has done. And then Shinhan is the one we started buying in January. The positions reduced as Chubb. Chubb was swapped into Renaissance Ray. We've still got a big position there. Signature Bank, another fintech bank in the US, has done very, very well. Kruk, a debt collector in Poland. Sparbanken Nord is in Norway, North Norway, one of the best savings banks there. And Arrow, another debt collector that's actually just had a takeout bid. So that price has also done very well. So the takeaways, sector sold off. It actually has recovered, but the valuation still protects against downside. Our contacts with management, and we try and speak to the management of every company we own at least twice, 2-3 times a year. It shows that they're very well positioned. The fund has a long track record. We've got an experienced team, and the performance you can see there. The fund and the sector has actually stood still for 4 or 5 years. So the recovery we've seen in share price is just taking us back to where we were in 2019. We really believe that the best is to come going forward, and that the sector will start outperforming that the turquoise line, the MSCI World. Mark, I'm going to leave it there. I think those you can all look at later. I don't know if you have questions.
Okay, that was very interesting. Thank you very much. There's a couple of questions that have come through, which I wonder if I could just deal with. And I hope we get time, because so much to ask. I wanted to speak to you about your views on the interest on the interest bogeyman, which you did address, and on the quantitative easing and when the party will end. It seems that 2024 seems to be the date that at least we've got safety till then. But I want you to just, if we just as an initial question, just speak to you about the fund, and the one that you with the figures that you've got on screen at the moment. Would it be possible for you just to run us through a commentary on how the fund has performed during this period, for those who are dialing in, perhaps aren't familiar with the performance of the fund, and then and where you see it going from here, please?
Okay, so this picture that we've got now actually is immensely frustrating for us. By the way, what you can't see, we started the fund in 1999. And that was when I was at Coronation. We brought the fund across to Sanlam in 2004, and all the investors came across as well. And why it's sad that we can't show that 1999 to 2004 period is that was a period similar to this. And the fund and the sector did very well there, sort of 70%, 30, 30, 30. And kept doing that, obviously, until the 2008 crisis. The years 2010 to 2019 were the most frustrating for managers of a financial fund, because of this continuously lower interest rates that put pressure on the bank net interest margins. We tried to overcome that by investing in emerging market banks, which over time always outperformed because of the stronger growth, but that didn't work because we had a period of a strong dollar. So you'll see there's a lot of volatility, and each year, like when the fund went down, it was because the emerging market currencies weakened when the dollar was strong. So that's why going forward now, you see in 2020, the fund, the first 2 months, it actually fell very sharply. And that always happens in the financial sector. You can see there in 2008 as well, when something happens in the world, your financial sector takes the biggest pounding and then also recovers the strongest afterwards. So you can see big fall in 2020. We come back, but I think the important thing, as you say, going forward, we are now basically in line where we've been for the past 5 years. And that's why that picture of Shinhan Bank in Korea is so important. During those 5 years, all these banks grew their earnings, they grew their shareholder value, but the share prices came down. So they are now still cheaper than they've ever been. And so we really expect the next few years to be one of those where you'll see a recovery, a 3-4 year recovery, as we saw in 2015-16, as we saw in 2009-10. So we think, in fact, internally within Denker, we've convinced our peers who run the global equity fund and the balance fund, we've all increased as a house our exposure to the financial sector for this run that is to come now. So for the next 2 to 3 years, we think the financial sector is safe because of the valuations and the capital ratios. But if inflation does come through and interest rates do go high, as we think, you're going to see a lot more upside.
Corky, that's interesting. Then perhaps again, for those who aren't familiar with the fund, in terms of your themes, what geographies are you looking at? Where do you focus the constituent parts of the fund?
Yeah, so the largest exposure is always directly or indirectly America. It is, well, with China, the largest economies in the world. It is the economy, one of the economies that will grow the strongest. So the US banks and the P&C insurers make up, it varies between 30 and 35%. At the moment, I think it's actually, as we speak now, because the numbers generally tend to be the last quarter, it's about 36% now in the US. So the US is the largest one. And then in Europe, we've more gone around Europe in countries like the Czech Republic, Romania, the parts of Europe that are growing stronger, and then ING, which we really like. In that regard, we are very company focused as well. We won't invest in a country because of the country. We want to invest in a good company. But a good company obviously does well when you have a good environment. So you can see here on the top 5 as well, LIC is in India, Citigroup is US, but it's actually a global company. Arch, again, is a US reinsurer and insurer, but it operates globally. TCS is actually a Russian fintech. It's one of the best fintech companies in the world. It's an unbelievable company. We invested in them shortly after they listed in 2013, and it's been a big position for us since then, and then JP Morgan. And you can see where we've invested recently. Legal & General is actually one we've held for a long time, but during the crisis, it was sold down and we added to that. It's one of the larger insurers in the world. KeyCorp, again, a regional bank in the US. Renaissance Ray, US. Sberbank, also in Russia, because of the stronger oil price. Russia is positioned to do very well. And then Shinhan. So in terms of geographies, largest US, second would be the UK, and then thirdly actually would be most probably now India. It's India and Europe.
Okay, a question has come through, and I'm just mindful of time. I think we've got literally 1 minute left. The first question that came through is, will the presentation be shared? That came from our counterparties in Zambia, and the answer is yes. We will make it available and we'll circulate it. No doubt we have a number of our attendees who will want to get back to Koki. The third, let's make this the last question, Koki. I know that you're on your way to the garden route in South Africa after this webinar. The team that you've got around you, just a quick word on your team and in terms of the fund management going forward.
Thanks, Mark. It's a brilliant question. Okay, so the team, basically, we've got 3 key analysts. That's Ben, Barry, and Craig, each with very strong responsibilities. So Ben does the in-depth research of all the larger banks in the developed market countries. So he covers all the banks in the US, Europe, Japan, etc., etc. Barry does all the insurers globally. So he's our insurance expert. If you need to know anything about the Suez crisis or the business interruption claims, Barry is our guy. And then Craig looks at the emerging market banks for us. And then we've got Liesel, who is our data manager. So if you think of it, we follow 400 financials globally. So Liesel is the one that makes sure that all the models are always up to date. Wherever we are, we can just pull up a model of any bank in the world and we've got up-to-date information. And in the wider team, we got Madeleine, who runs the Balanced Fund and who is basically also our in-house economist strategist. So we always bounce off all the global themes with her. And a lot of what I've been saying earlier in terms of where the economy is going is the shared wisdom with her and also Arthur Kamp, who is the Sanlam economist. So the total Denker team is 25, but so there are 5 of us who basically run the financial fund.
Okay, that's fantastic to hear. Yeah, the attendees, we know Arthur well. He's presented for us a few times.
He's great.
Okay, from a personal point of view, yeah, indeed, I must agree. Koki, from a personal point of view, it's been fantastic listening to you this morning. It's been long outstanding that we wanted to host you, so it's been a great privilege. I'm very pleased that the fund has made such a great strides over the course of the last couple of months. We will no doubt reach out to you again to speak to our various jurisdictions. But in the meantime, from me here in Kenya, from the team in Mauritius, and from Koki in Cape Town, we want to thank you for attending and hope you have a great day. Don't forget that tomorrow is the last of our Funds Week sessions that we're having with the Sanlam Global High Quality Fund. That is in your invitation. Link is just a matter of clicking onto it. So we look forward to hosting you for our final session tomorrow. Thank you very much for attending, everyone. Koki, thanks once again. Cheers.
Thanks a lot. Thanks, Mark. Good.